A very good morning to all our participants. We thank you for joining us on this special webinar presented by Taxsutra and BDO on union budget analysis, where BDO partners, along with an industry expert, shall discuss the impact of the Union Budget 2023, decode the tax proposals, and explain the implications for business and trade. Our first speaker, Mr. Ronnie Anthony, is a BDO partner and leader with a tax and regulatory practice focusing on corporate tax and is based out of Bangalore. He has over 17 years of professional experience in handling domestic tax, international tax, and transfer pricing engagements. He has led several large engagements in India and internationally across diverse industry verticals like information technology, manufacturing, pharma, real estate, and much more. He has extensive experience in handling complex litigation matters as well as large APA engagements. He has also been a speaker on tax topics at several local forums as well as a teaching faculty at the ICAI for the diploma course on international taxation. Our second speaker, Mr. Dinesh Kumar, is an associate partner with the indirect tax practice at BDO. He is based out of Kochi and has over 30 years of professional experience and spearheads thought leadership and learning and development initiatives. His expertise includes assisting clients in areas of GST, customs, FTP, free trade agreements, central excise, service tax, VAT, and much more. He has more than 35 years of industry experience in working in large conglomerates at several senior level positions and possesses over 9 years of consulting experience in a large consulting firm. He has been at the forefront of VAT projects during 2005 to 2007 and GST projects in 2013 to 2017 and has experience in dealing with challenges associated with the implementation and designing tailor-made solutions. Joining in to give us an industry perspective on the Union Budget 2023, our third speaker for today is Mr. Simachal Mohanty. Simachal is currently working as head global taxation with Dr. Reddy's Laboratories Limited. He handles both direct and indirect tax functions for Dr. Reddy's group across the world. As part of his current role, he is responsible for tax compliance and tax planning for the group. A chartered accountant and a LLB, he has over 25 years of experience in the field of global taxation and transfer pricing. Prior to his current employment with Dr. Reddy's, he has worked in Murugappa Group and Polaris Software. He was awarded as CA Professional Achiever Healthcare Sector Award by ICAI. He has also served as the chairman of the International Fiscal Association Hyderabad subchapter in the past. Before I hand it over to our speakers, I would like to take the opportunity to apprise all of you that in the last 10 minutes of the webinar, we will host a dedicated question and answer session. For this, I request all of you to post your queries in the Zoom question and answer box. With this, I now hand it over to Ronnie, sir.
Um, Thank you, Thanaya, and thank you to also the over 230 who've joined us in this webinar. Obviously, the 1st of February is now like a landmark date where the union budget is presented, and all of us have now grown to accept that as the default date for the union budget. And with it, a lot of great expectations every year in terms of tax rationalization, in terms of what it will do for the economy, in terms of budgetary allocations. And this year's budget also did not fail to impress insofar as the some of the announcements were positive. What we will do through the course of this 1 hour is take you through the key provisions from a direct tax perspective, from indirect tax perspective, and we also have an industry speaker, Mr. Simachal Mohanty, to give us the impact from an industry perspective and how industry views the tax proposals. To begin with, let me just talk about the direct tax proposals. The biggest announcement, and I think the most expected announcement, was on the rationalization of the tax rates for individuals. And the individuals, and I think there was a tacit acknowledgement of this by the finance minister, that the individuals do contribute the biggest chunk of the tax share because they are definitely the most taxed class. She did bring out the disparity in the peak tax rates for the individuals versus others, and therefore they sought to rationalize some of the tax rates. What I have presented on the screen is the tax rates under the new tax regime. Now, the new tax regime was something that the finance minister has been pushing forward to, primarily because of the fact that the erstwhile tax regimes or the old tax regime held a lot of impetus or gave a lot of incentives which were based on deductions, which were based on certain exemptions and rebates, etc. And the idea of the finance minister has always been to rationalize the tax structure in a manner that the exemption component of the Income Tax Act is done away with. So therefore, the new tax regime has to have a differential tax rates and slab rates such that it does allow for people to opt out of the exemptions that they have been enjoying and move into a rationalized regime which will have a fixed rate of tax for income levels. Now, if you look at the proposed slabs of the income new tax regime, well, there are again graded slabs of 5, 10, 15, 20, and 30%. If you do we've done a comparison between uh, the current tax slabs under the new regime. And as you can see, it does have a differential outlook in terms of the taxation of the various slabs in the proposed amendments. Now, if you look at this particular thing, while the income levels above 15 lakhs continue to be taxed at the highest rate, there is some marginal differences and changes between the 3 lakh to 15 lakh rate. We've done a small analysis of the impact. And one thing that is notable is while there is a impact on income levels below 15 lakhs, there are certain differentials for income levels above 15 lakhs. For example, based on our analysis, under the old regime, while 25 lakh gross total income would be taxed at 4.60, under the new tax regime, there would be a 4.68 lakh impact on the taxpayer. This is all assuming certain deductions, etc. Now, what does become important is that there was a very significant differential for incomes in excess of 5 crores, and that's something that the finance minister has sought to deal with. So let me just go on to the proposals, etc. Firstly, if you look at the surcharge, that was one area where it was leading to a very high tax rate in the case of high net worth individuals with income in excess of 5 crores. So there's been a reduction over there. The surcharge, which was the existing rate of 37%, was reduced to 25%. So therefore, there is a differential from the peak rate of 42.3. It's now come down to a 38.6, which is a marginal difference of 3.7%. The rebate limit has been modified. So therefore, the rebate limit has been modified from 5 lakhs to 7 lakhs. So effectively, anyone with incomes up to 7 lakhs could enjoy a no tax proposition under the new tax regime. There's a small error over here in the third slide. The standard deduction is still 50,000, but nevertheless, there is the effective benefit in the new tax regime could be as high as 52,500 rupees to most people who opt for the new tax regime. There were certain other announcements that the finance minister proposed. One is on the income from insurance policies. Obviously, the ministry did find that high net worth individuals who are paying premiums in excess of 5 lakhs in insurance policies other than unit linked insurance policies were getting certain benefits which was not the intention of the government. So therefore, where the income from insurance policies, especially where the premium or the aggregate of the premiums in every year exceeds 5 lakh rupees, uh, in such cases, the income will be taxed as income from other sources. And modifications have been made to the act or proposed to the act to make reflect these changes. Now, one thing that came out from the budget proposals was that the FM mentioned that the new tax regime would be the default tax regime. So therefore, there has been no changes in the slab rates under the old tax regime. But new tax regime is the favored option of the government, and there seems to be significant push from the government on this matter. I see that a lot of hands are being raised in the, while the webinar is going on. Please do feel free to ask your questions in the Q&A box, and Tanaya, me, and Dinesh and Simachal can take this up at the end of the presentation. Now coming to the industry. Well, there is no change in the corporate tax rates. So that's something, because the effective rates are already pretty low. So therefore, the government has not proposed any changes to the corporate tax rate. But there has been some rationalization of the different, laws impacting corporates and bringing a bit of parity. And what I will do in the next couple of slides, take you through both the impact on businesses, as well as specifically certain sector-based issues that have been dealt with in this budget. Now, one important amendment has been for SEZ units. Now, currently, there has been no, at least from the beginning of the SEZ regime, there has been no concrete timeline for bringing in the proceeds under the SEZ law. Obviously, they were governed by the RBI regulations, which again permitted SEZ units certain beneficial access in terms of the forex coming into India. But now the government has proposed that the time limit for bringing in the proceeds of any export done by an SEZ would be restricted to 6 months, or such other time as may be allowed by the competent authority. The current competent authority is the Reserve Bank of India, or such other authority as may be prescribed from time to time. Now, this is obviously going to impact all the SEZs, but primarily we have, based on our understanding, it's not something that SEZs by large have been facing a problem on, but certainly SEZs which are export oriented, which do not have, or which have individual independent contracts, etc., could have an impact on this, and therefore it will need to be seen how this will finally pan out in the future, and when the final bill becomes the final act. Another change that is proposed is on the MSME units. Obviously, the government has been encouraging MSME units and their functioning and their development over the last couple of years. And if you look at it from a corporate governance standpoint, Companies Act already required companies to publish data regarding the outstanding to MSME units, etc. I think the government has sought now to align it and has brought amendments to 43B. Now, 43B primarily dealt with certain types of payments which were allowed on a payment basis and not accrual. But now that is now extended to MSME units also, where the default provisions of the MSME Act is 15 days of payment, but unless there's a contractual obligation or a contractual agreement to pay in a period not less than 45 days. So therefore, where any company is paying to an MSME unit, it will be allowed on a payment basis so long as it's within the time prescribed by the MSME Act. And therefore that will become very, very critical for companies which have a large supply chain within the MSME sector to monitor their payment schedules. This will also require a lot of additional inputs that industry will need to look into before as part of even their tax audits, etc. We'll obviously have Simachal comment on this at a later point of time, but this is definitely an impactful change that's come up. When it comes to presumptive tax, obviously there has been some rationalization. Currently, the limits for presumptive taxation for businesses and professionals was 2 crores and 50 lakhs respectively. Now these have been enhanced to 3 crores and 75 lakhs. Obviously, with the added thing that 95% of the income ought to be in not in a manner not other than cash. So therefore, that's going to be a big relief to a lot of professionals and businesses which have turnovers less than 3 crores. Now 94B was a provision under the act where in the case of interest payments, especially where the interest was made to certain parties, there would be an interest deduction limitation under the act. Now, while financial sector was, at least banks at least, were primarily out of the ambit, NBFCs did feel that they did not have a playing field or a parity, while NBFCs were governed by the strict governance norms issued by the Reserve Bank of India. This interest deduction limitation did not apply in the case of the NBFC. So the government has made that amendment to bring a parity between banks and NBFCs. Obviously, there will be a notified NBFCs which will where this interest deduction limitation will apply. One area again that's also been amended is on the cost of acquisition for intangible assets or rights. While there was a debate on goodwill, etc., which while there were different judgments of the Supreme Court, and the government made amendments to deal with the goodwill issue in the past. For other intangible assets, also it was felt that there was a lack of clarity. So therefore, it is clarified where the cost of acquisition for intangible assets, where no consideration has been paid, would be treated as nil and therefore subject to capital gains while computing the capital gains for transfer in case of intangible assets. Now, another one amendment which I think primarily impacts the real estate sector, but also equally important for especially individuals. This was in the case of joint development agreements. So therefore, there's a clarification that the modes other than cash is also includes check or electronic payments, which is used to compute the total consideration. So therefore, there was a belief that by the wordings of the law, people were considering that modes other than cash. So did not, since the law 45(5)(a) included the words cash, modes other than cash, which is check and electronic payments, were to be excluded by 45(5)(a). I think the government just made those amendments to bring parity or bring at least clarification. Now, TDS has largely remained one area where there's obviously ongoing changes. A big issue that most taxpayers faced was the unavailability of TDS credit, especially where there was a differential in the years in which the tax was deducted versus the years in which income was offered to tax. And this could primarily arise in situations where TDS is deducted on advance payments, but the income being recognized in a subsequent year. Now, in order to allow for such issues to be dealt with, there's been amendments proposed where the taxpayer can make an application to the tax officer within 2 years for granting such credit in the year in which income was originally offered. Now, another thing which got amended was the provisions of 35D, which dealt with companies which were, as part of the preliminary expenses, had project reports and assessments being done. Now, previously, this required that this be done by an agency notified by the CBDT or approved by the CBDT. This was obviously not a very, very conducive one for the industry. So slight amendment has been changed. So now a self-declaration by the taxpayer would suffice, so long as it contains the particulars as prescribed by the department. So the particulars obviously will be prescribed at a future date. Yeah. Going on to the capital gains. Well, there has been an insertion of a new section 50AA, which provides for treatment of capital gains on market-linked debentures. Now, currently, they are being taxed at 10% without indexation as long-term capital gains. The government felt that this is not the appropriate way to tax it, and therefore this is now being proposed to tax as short-term capital gains through applicable tax rates or 30%. So therefore, they have made it, obviously the definition of a market-linked debenture has been defined as a security which has an underlying principal component in the form of debt, and where returns are linked to market returns. Now, this obviously does change the dynamics for market-linked debentures. One has to wait and see how the financial sector also reacts to it. There's been a lot of chatter on the ground that this could probably spell the death of an MLD because of the tax rates that are being prescribed. But one has to wait and watch and see how the final bill will play out. If there's pressure on the government to revisit this, there could be a possibility that this may be revisited. But currently, as the proposals stand, market-linked debentures is now being proposed to tax at 30%, as against the current practice of taxing them at 10%. The assessments and litigation, as usual, every budget, there is some amendment in the proposals so as to deal with the assessments and litigation. And this year was no different. There has been proposals which are rationalizing some of the timelines, proposals that are enhancing the capability of the department, as well as ensuring that department gets its time to deal with the requests and also from the taxpayers, so as to be able to deal with the assessments in a proper manner. I think the memorandum to the finance bill clearly laid out the government's argument that department was not getting sufficient time to carry out assessments properly. B, there was obviously an impact on the structure of the department, which did not permit it to effectively handle and dispose cases. And three, that the department needed due time, and also taxpayers also needed to furnish details within a reasonable period of time. So let me just deal with those three amendments which we believed are important, dealing with how the government views the assessments and litigation aspect of the Act to modify. One is the increased time limit for closure of assessments. Now, the current time limit is 9 months, even in the case of an updated return. Now that's been reinstated to 12 months. Now, what this effectively does, or at least the case that was made by the finance minister, was that the department did not have sufficient time to formulate a strategy or formulate a response, and therefore there was hurried disposal of assessments. B, given the voluminous data and investigations, etc., that needed to be carried out, it was important that department get its fair time to react to the SSE's submissions, to react to the SSE's request for hearings, etc. And all of this is in the context of the now faceless scheme. Now, in the faceless scheme, as those who are familiar with this faceless scheme, there are multiple units within the faceless scheme which coordinate the activities, right? So there is so the multiple units need to coordinate, and therefore there was time lag for that coordination, which unfortunately led to situations where assessments had to be hurried up. What that also meant was assessments were being done in a manner that did not take the interest of natural justice into consideration. So taxpayers also were being impacted. So this is obviously an important development. One will wait and watch and see how this development pans out. But certainly, this is a welcome relief even for taxpayers to have the proceedings to be completed within a period of 12 months, because it gives taxpayer also sufficient time to respond to notices of the department. One big area which I think has been laid out in multiple reports in the past, has been the of uh, 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 pendency of appeals, especially at the commissioner appeals level. Now, what the government has now proposed is that they are creating an additional layer at the first appellate level, which is the joint commissioner or additional commissioner appeals. Now, what is the function of the joint commissioner or additional commissioner appeals? It is to handle cases which relate to small amounts of disputed demand. So the idea being the commissioner appeals would have a higher threshold of disputed demand to be dealt with, whereas lower thresholds matters relating to certain penalty cases, 143.1, 143.3, 144 matters, which do not result in a significant dispute demand. The proposition is to have a new level called the joint commissioner or the additional commissioner appeals. This is a very welcome relief to the taxpayers in as much that now small matters can get speedily disposed of by creating this additional layer, whereas larger matters continue to be handled by the commissioner appeals. The third amendment is on the time limit for furnishing transfer pricing related details to the AO. Now, earlier there was a 30-day period which could, and taxpayers were also seeking additional time from the AO in terms of during the course of the TP audits for furnishing data. Now, uh, the the department or the finance minister rightly felt that this is not leading to a conducive conclusion of TP audits, and therefore, to that extent, the time limit for furnishing this data is now reduced to 10 days. And if at all an extension is sought, the extension cannot exceed a period of 30 days. What that means is also for taxpayers to definitely be ready with the data requested so that they are able to conclude TP assessments in a conclusive manner, and also giving the department due time to make the relevant considerations impacting TP assessments. There have been some changes in the penalty provisions. Nothing too significant, but certainly worthwhile noting. In case of specified financial transactions, there was where there was an inaccuracy due to furnishing false or inaccurate information, which was submitted by the account holders. There was no situation, or there was no currently enabling provision because the data that the account holders provided was what was finally submitted as part of the SFT. So therefore, there was no enabling provision for a penalty. Now the penalty of 5,000 per default has been prescribed where an inaccurate information is furnished by the account holder. There was also no penalty in the case of 194R, which dealt with the TDS on perquisite, which was introduced last year, and also 194S, which is the TDS on virtual digital assets. There were no penalties associated with non-withholding of taxes in those cases. Now the penalty and prosecution provisions have been extended to these defaults also. Yeah. Coming to the withholding tax, there's been a huge amount of changes on the withholding tax bit. What I'll cover over here are certain provisions impacting the industry at large. One is obviously the tax collected at source. Now they have, increased the tax collected at source on store packages from 5% to 20%. So erstwhile it was 5%. Now it's increased to 20%. Now, the TDS on foreign remittances through the liberalized remittance scheme, except where it is for remittance towards education, where the rates have remained unchanged. So education and for medical purposes, the rates have remained unchanged. But for every other remittance through the liberalized remittance scheme, there's an increase from 5 to 20%. And previously, where there was a basic threshold exemption, even the basic threshold exemption has been done away with. This is one area which will obviously need to be looked into, especially for people who are using the LRS scheme to remit money outside India. Then there's also a clarification that a person is not required to furnish a return of income in India, who is not required to furnish a return of income, would not be subject to TDS and TCS under 206 AB and 206 CCA. In the case of withholding tax to non-residents, in case of units of mutual funds, there was no clarity on the applicability of treaty rate. They were taxed at the domestic rate, but there were representations made that where a treaty rate is lower, such treaty rate should apply. So now it is clarified that the withholding to non-residents, insofar as units of mutual funds are concerned, would be the lower of domestic rate or treaty rate. The interest on listed debentures to residents, which was erstwhile not part of the scheme of TDS, is now subject to TDS. So that's going to be an additional burden for interest on listed debentures, because there was a feeling that this led to either non-disclosure of income in the hands of the recipients. So it's to plug that particular loophole that now the interest is also subject to withholding, because that automatically will require a filing and as well as a disclosure of such interest in the hands of residents. Non-resident taxation was one area where there has been some amount of changes. Hitherto, gifts received by non-residents in excess of 50,000 was brought to the tax net. But what was happening is, in the case of residents, but not ordinarily resident, this argument was being taken that that would not be subject to tax. Therefore, to plug possible evasion in such cases of gifts, even gifts received by not ordinarily residents from residents is sought to be brought under the tax rate, under the deeming provisions. Also, in the case of presumptive taxes or presumptive basis of taxation, in the case of 44BB and 44BBB, in the case of exploration and civil construction, there were arguments being proposed by taxpayers that in certain areas, certain years, they could opt in for the presumptive basis of taxation in case of higher income and opt out where they were making losses. So in order to plug the anomaly of opt-in and opt-out, that opt-in and opt-out provision, there is no ability to set off unabsorbed depreciation and brought forward losses where the taxpayers have sought to be taxed on a presumptive basis. So that deals with the loophole where taxpayers were usually allowing for these unabsorbed depreciation losses, which they claimed, or in the years where they opted out of the presumptive basis of taxation. Now, in the case of, again, the third element, which is amendments to Section 56, is where the private limited company received consideration from residents in excess of the FMV that it was taxed as income from other sources under Section 56. Now, that provision has been extended to non-residents. So in the case of consideration received from non-residents, where the consideration is in excess of FMV, this private company would be subject to tax on the differential. This is obviously expected to bring in a lot more litigation on this area, because the concept of there would be plenty of amendments or litigation one is expected on this area, and one will have to wait and watch how this will pan out in the future. Startups received much attention from the finance minister, and also has been receiving a lot of attention in the last 1 year. Obviously, the government views startups as an engine of growth for the Indian economy. To enable startups again to have a more structured gestation period, as well as also to enable certain anomalies to be rectified, two changes have been made to startups. One is the sunset clause for obtaining exemption has been extended from 31st March 2023 to 31st March 2024. So that's an extension for 1 year. Secondly, where losses have been incurred, previously it was a period of 7 years from the date of incorporation. So long as 51% of the shareholding shareholders constituting 51% continue in the year in which the loss is set off. That anomaly has now been adjusted to 10 years to bring it in line with the 80 IAC period itself, so that there's an alignment of both the 80 IAC as well as the ability to set off the losses that are incurred during such period. There have been a few changes on the real estate sector. One is the case of interest deduction. So therefore, where interest has been claimed under Section 24 or Chapter 6A, it is clarified that such interest would not form part of cost of acquisition or cost of improvement while computing capital gains on house properties under Section 48. Taxpayers were taking a position that such interest would form part of cost of acquisition and cost of improvement. The finance minister felt that in order to bring priority, and especially where such interest has been claimed under Section 24 while computing income from house property or the provisions of Chapter 6A, it should not form part of the cost of it. So there's been a rationalizing of that provision. One big chunk amendment, which obviously will impact a lot of high net worth individuals, is the rollover benefit of Section 54 and 54F on investment in of these capital gains from transfer of a residential property or transfer of a long-term asset into a residential house property is now being capped to 10 crore. Again, the ostensible reason is that in such situations, that is not the intention of the government. The benefit was given to allow for increased house ownership for people who are who have gains from capital gains to allow them to invest it in resident properties and increase house ownership. But such benefit has been now capped to 10 crores. In case of REITs and InvITs, there has been some changes that are now modified, which is primarily on the repayment of debt or capital. While interest, dividend, and pass-through, the rental income, etc., continue to be treated as pass-through for REITs and InvITs. In case of income distributed as repayment of debt or capital, which was hitherto not taxed, now there's amendments have been proposed to bring them to tax within the ambit of Section 56 of the Act, and also a proviso under 115 UA, so that these would be has been made so that payment received for repayment of debt would be reduced from the cost of acquisition of units to the extent the cost does not exceed the sum so received. So this is again a parity on the repayment of debt and capital, which the government feels is not the reason or not supposed to receive the benefits of the pass-through treatment for REITs and InvITs. One sector that has received a lot of attention is the online gaming sector. While the provisions were there in terms of withholding tax on gambling, income, etc., on horse, racing, etc., these provisions did not adequately cover the government's position on the treatment of online gaming. So a new provision has been introduced such that the entire online gaming activity would be subject to withholding tax. Now, the withholding tax rate is proposed at 30%. There's a concept of net winning, and the net winning concept will need to be clarified at some point of time in the future. But the amendment has been made both in terms of taxing this under 115 BBJ, where a new section has been introduced to tax this at 30%. The withholding tax provisions have also been modified so that the companies where the participants take part in online gaming activities, when they are releasing the net winnings, they would need to do a withholding of 30%. Now, how is this impacting? Well, obviously, there's been a significant growth in the online gaming industry in the last several years. And therefore, one has to see the impact on the online gaming companies. It was obviously going to be a little bit of difficult, because how do you define net winning, and in the manner in which online games are structured, a net winning is a fluid concept. One will have to wait and watch how the net winning is defined, and how this provisions will be implemented in the final enactment, as well as any other rules to be prescribed in that. And it'll probably be an interesting area to watch out for. But what this will do is stem a lot of litigation relating to TDS on online gaming, which it'll rationalize it. And one does expect that over a few next couple of years, there will be some element of rationalization on the withholding tax provisions over the period. There's obviously a very interesting matter which is pending now, I think, before the Karnataka High Court in case of GST on online gaming. And I think that's one area where maybe my colleague Dinesh can touch upon at some point during his presentation. But that's an area that's also interesting to watch out for, and we'll probably be viewing the sector with interest over the next couple of years to see how these developments happen. Coming to the last segment of the direct tax proposals, the IFSC again has received a lot of attention from the government. If one goes through the budget speech of the finance minister, she did focus quite intently on the financial sector as one of the growth engines for India. And therefore, in that regard, the IFSC did receive a lot of attention during this current budget. There are three changes which we believe are relevant for the discussion on IFSC. One is the extension of tax exemption to relocation of offshore funds. Now, the current limitation period was 31st March 2023. That's been extended to 31st March 2025. The second is on offshore derivative instruments. Now, there's been a clarification on the exemption of this income from offshore derivative instruments, because they were being subject to double taxation, one when they were being received at the IBU level and thereafter at the payment level. So therefore, this has been extended to the distribution itself, because if the IFSC banking units are being taxed at it, the distribution is getting the pass-through benefit. So there's a clarification on the this particular taxation. The final amendment on IFSC related announcements was the IFSCA fund management regulations has come into place in, I think, May of last year. So some of the definitions of the IFSC fund management regulations are included in the Income Tax Act to allow for parity, so that there is clarity of discussions between the Income Tax Act and also alignment with the IFSC fund management regulations. With this, I will conclude the direct tax proposals. I will request my colleague Dinesh to take over the indirect tax proposal. And Dinesh, I'll run the presentation for you, so that, and do let me know a cue when you want to shift. Dinesh, you'll probably need to turn on the no, Dinesh, you're not audible. No, you're still muted. It's still showing muted.
I think it's fine now. Dinesh, can you speak out?
No, we still cannot hear him. Dinesh ji, I think it's better if you can rejoin using the same link, because we can't.
Yeah, I'm audible now.
Yeah.
Perfect. Yeah, this is much better.
Okay, fine. All right. So after the lengthy direct tax proposals, I'm moving to the indirect tax part of the union budget. And first of all, thanks Tanya for the introduction. And as we move along, it's first of all, it's my privilege, and I'm really delighted to be, part of this forum to discuss about, the amendments which is carried out through the union budget 2023-24. So before I go into the specific proposals contained in the union budget, I would like to also briefly touch upon the backdrop in which this particular budget was presented. Now, it is of course a fact that the conflict in the eurozone continues to be a concern for everyone, and also the spiraling inflation, which is of course a shadow of the global phenomena which is happening. But still, there was a lot of expectation, particularly from an indirect tax front, because we have passed the worst of the pandemic and it's behind us. And also the economy is also showing some bright signs of recovery, and it's bouncing back, including the tax collection which is happening in the current fiscal. Whether it is direct tax or indirect tax, and particularly in the context of GST, the collections have been very good compared to the previous years. I think the government has been able to consistently collect above 1,40,000 rupees per month, and average actually it looks like 1.5 lakh crore average monthly. So it was expected that we may possibly think about moving from the incremental changes to maybe something quantum, because there has been discussions which is happening about merger of these various tax slabs that we have, which is currently at about 0, 5, 12, 18 and 28%. Of course, this is excluding the compensation cess and the 0.25% or 3% which is applicable for precious metals and all that. So there was still an expectation that this is something which is likely to happen, or at least there will be some roadmap which is laid on the proposal to possibly merge these tax slabs and possibly bring it down to 2 or 3. The other expectation was there will be some announcement about the convergence of petroleum sector into the GST, petroleum power sector. This is an expectation. Of course, this is something which cannot be done by the union government alone. Of course, there has got to be a consultation that has to happen with the state governments also. But there has been discussions in the past. It was expected that there could be some discussion around this which is happening, and there could be some indications about this in the current budget. Of course, any integration and moving towards a lower number of slabs would go with exemptions, removal of more of the exemptions. But anyway, there are no discussions about this. It was expected that there could be some indications to give some kind of a compliance ease, because as it stands today, the GST compliance is one of the most complicated in the fiscal tax regime. So this is something. And one particular discussion which everybody was expecting is about the phase out or possibly the 2.0 of the SEZ law. Because in the union budget or in the presentation of the union budget in 21-22, finance minister specifically talked about the SEZ law, and we also saw one Desh draft act which is going around in the public domain, even though it's not official, it's been there. So there was an expectation that this is something which is likely to be, there will be some discussion around this. Unfortunately, there is no announcement on this. And of course, the foreign trade policy also has expired, and it is being given a fresh lease of life every year, be giving an extension. So it is expected that there could be some kind of discussion around this, but unfortunately, there is nothing on this count also. So be that as it may, we will possibly go and discuss about what are those specific proposals which is contained in the budget proposals. So starting with goods and services tax, I think the first point is about the credit which is available on expenses incurred for corporate social responsibility obligations. In fact, there's already a lot of discussions that is happening around this in the public forums. But what the government has sought to do is to restrict the credit on expenses incurred or GST support on various expenses incurred for corporate social responsibility obligations under Section 135 of the Companies Act. Now, the questions that are being asked, this being a prospective amendment, what will be the implication for the past period? So that is something which there is a lot of discussion about. So are you saying that this credit would be available for the past period, but not available on a prospective basis? Secondly, the CSR obligations are capped at certain percentage. So if somebody spends beyond that, so what could be the creditability in respect of those expenses or those GST support on those expenses? That continues to be a question which is being asked from everyone. So as we move along, I think this is something which needs to be unearthed. Moving over, there is a specific provision for reversal of credit on exempt supply, because you can't be taking credit of ITC on for the purpose of supply of taxable as well as exempted goods. So here the reversal which needs to be carried out. Now there is a new amendment which is being carried out to bring in specifically the bond sale, which is the sale which is happening from the warehouse. So this is something which will happen on a prospective basis. This is the next one. Then the third proposal with respect to the input tax credit is there is a limit of 180 days for claiming of the input tax credit, within which you go to pay the supplier also. So I don't see anything significant in this amendment. It is nothing but just to reword that particular section. Doesn't seem to be causing any major change in the provision as such. Then moving over, next one is about the change in the IGST law, where there is a place to supply with respect to the transportation of goods, particularly when the supplier and the recipient is located in India. So there was a confusion, for example, in the case of a B2B supply. Now the both supplier and recipient located in India, but the goods are consigned outside India. So the proviso which was there, which is causing a confusion whether that would be construed as an export. So actually, as it stands today, there's it is liable to be taxed and it's available for credit also. There was a clarification which came in December. So that stands clarified, but then that particular section, which is still continuing in the statute, has become infructuous. So that is something which is sought to be deleted. Moving forward, Ronnie, can you please go to the next slide, please? Yes, now we come to the penalty and offences. Now we've been reading about few news items, saying that there is a proposal to first of all decriminalize some of the offences under the GST law, and also possibly try and relax, the prosecution proceedings. In line with that, there are 2-3 proposals which has come in. First of all, the prosecution, the threshold for the prosecution itself, the launch of prosecution itself has been increased from 1 crore to 2 crore, except in case of somebody who is issuing invoice, fake invoice as we generally call. That is the case where you raise an invoice without a corresponding supply. So that is considered as a fake invoice. So except in those cases, the threshold stands increased to 2 crore from the current 1 crore. So this is one of them. Second one, we discussed about the decriminalization which is being proposed. So in line with that, 2-3 specific acts have become decriminalized. They are: 1, obstructing or preventing an officer from discharge of his functions, or deliberate tampering of the material evidences, or failure to supply information, or supplying a false information. All these would fall outside the scope of the criminalization. So they are decriminalized now. And there is also changes in the compounding of offences. Now, of course, the fake invoice is something which would not be eligible for a compounding. So that will continue to be subject to, not only prosecution, the compounding also would not be available. And few things have been brought under the compounding provision, which are, dealing with goods, which in any way is liable for confiscation. Secondly, receives or concerns with supply of services, which is in contravention of the GST law. So that is also kept outside. That is, of course, brought. That also would be eligible for compounding. And the compounding amount also, from 50% to 150% of the tax amount, it is brought down to 25% to 100% of the tax amount. So these are the proposals which is there for penalty and offences. Then we move forward. Ronnie, if you can please take us to the next slide. Yeah. Now here is a retrospective amendment to Schedule 3, because Schedule 3, lists out the item which is considered as non-supply. So there was an amendment which was carried out in effective 1st of February 2019, in respect of the goods which are on a merchant trade transaction taking place, the transaction which is not touching India. For example, goods moving from US to UK, or from Pakistan to Sri Lanka. In those type of transactions, it is called out and out sales in some places. And similarly, there are bond sale where the goods are lying in the bond. From there, the sales are effected. Otherwise, it is not brought into the domestic. It is not brought into the domestic tariff area or domestic market. So it is being sold from the custom bonded warehouse itself. Thirdly, it is applicable for the HSS also. That is high sea sales. In all these cases, it was not considered as supply. And this amendment was carried out with effect from 1st of February 2019. Now, this particular amendment seeks to take it from the initial day or from the first day when GST was introduced, that is 1st of July 2017. So it's a retrospective amendment. Any tax that may have been paid on account of this in the past, that would not be available as refund. So that also has been specifically brought in the provision itself. The next one is about the sharing of information. So this again is subject to the approval from the supplier as well as the recipient. Certain information which is there in the GSTN portal, for example, what is given through the registration application or what is there through the daily, the monthly return or annual return, those or e-invoicing or e-waybill, those information which is available in the common portal can be shared with other portals also or other such system, it says. So mostly it is going to be with other governmental agencies. Possibly we're going to wait and watch what is it that seek to cover. Moving forward, Tony, if you can please. Now there are some changes with respect to the e-commerce operators. Now, one of the relaxation which is done is, the smaller suppliers were not allowed to effect, particularly suppliers of goods. Even services also not eligible to effect supply through a e-commerce platform. Now there is a change has been carried out which enables suppliers of goods can opt for ECO, and they can also opt for composition scheme. So the restriction which were there earlier is those who are in the composition scheme, they cannot effect the sales through e-commerce platform. Now, with respect to supply of goods, this particular option is available. They can continue to have the composition scheme and effect supplies through e-commerce platform. And there are some consequential amendments in the ECO provisions also. If ECO provisions, ECO violates the provisions like, a person who cannot, unregistered person effecting supplies through e-commerce platform or making an interstate sale, unless otherwise it is specifically provided or permitted under the law. If they effect those kind of transactions, that ECO also would be liable to pay a certain penalty, which is up to 10,000 rupees or, or the equivalent to the tax involved in that. So these are certain penalty provisions applicable for e-commerce platforms. Moving forward, we have some changes in the online information database access or retrieval service. We call it OIDAR in short. So earlier, in fact, the definition of OIDAR specifically speaks about, or in fact, the phraseology which is used in the definition, it says supply being essentially automated and involving minimum human intervention. So there has been a lot of litigations around in the past, specifically centering around this particular phraseology where they say what is essentially automated and involving minimal human intervention. What is minimal human intervention, whether it is 10%, 80%, 90%, and this has been something which is being fought in various forums. So now the government has quietly removed that particular provision or that particular phraseology. So I think this can potentially open up more litigations in the coming times. And another consequential amendment which is coming, in is non-taxable online recipient definition is something which is being made very simple. There's that anybody who is unregistered, because the earlier definition was very extent. It talks about governmental agencies, individuals, those who are into commerce or industry. So all those things have been removed. They merely said anybody who is unregistered, and that unregistered would include governmental agencies also who are required to deduct tax. So that is the amendment which is coming in. Then we go to registration. It is an innocuous looking amendment, but then I think this can potentially open up, some questions, because as you know, section 22 is the omnibus provision where the suppliers are required to take registration, and then section 24 speaks about certain cases where the suppliers are obliged to take registration, notwithstanding section 22 is not fulfilled. So this was the provision, and 23 used to be where a person not liable to take registration, who is none but those who are exclusively engaged in supply of wholly exempt or non-taxable supplies. Now the amendment looks more or less the same, but then the new amended version starts with the non-obstante clause. It says notwithstanding section 22 and 24. So the question that, or the doubt that is being raised today is when it is a non-obstante provision, can we say that those who are required to take registration under section 24, for example, somebody who is obliged to take a registration for fulfilling the obligations under reverse charge mechanism or an ISD, can they also take refuge under this and not take registration is the question that is coming in. So anyway, that is something which is there in the proposal. Maybe we'll have to wait and watch what is going to be the final shape of things, post which we can possibly deliberate on this and more. The other changes with respect to the compliances, in fact, the various returns which is being filed, whether it is monthly return or annual return, or the monthly return, there are multiple. There is one, of course, we have got this declaration of the outward supply, and then of course we have the final return where you adjust the tax liability, using your ITC, and then eventually you make a payment and you file 3B. Similarly, there could be GSTR 9, 9C. All of them, they did not have a outer limit for filing the return. Now, this year, the government wanted to specifically bring in a provision to cap the time limit up to 3 years from the due date of filing of such returns. So that is another amendment which is coming in. Then something relating to refund, I think it is not something which we could possibly wait and watch, what is it that the government seek to do in this, because it speaks about a situation where the refund is granted beyond a period of 60 days. What is the methodology and way in which the interest has to be calculated? So that needs to be prescribed in the rule. Possibly we'll have to wait and watch. Ronnie, if you can please take it to the next. Now we come to the customs proposals. There are not many. I will touch upon 2 or 3. This is one of the proposals which has come out in the current budget, because in the finance minister presented the budget for 21-22, there was a proposal which says that any conditional exemptions which is given would be valid up to 31st of March, immediately following 2 years. After that, it got automatically lapse. This is what the provision. So in fact, at that point in time, people used to wonder what is the purpose of this particular amendment. Now, what happens is, while doing this, there are so many other exemptions which is going beyond the period of 2 years. You could possibly think about cases where, there is a multilateral or bilateral trade agreements, which of course will go beyond a period of 2 years. There could be cases where some of the exemption which is given to, for example, UN, or there could be some exemptions given under the foreign trade policy. There could be exemptions which is coming through, certain central government schemes, which is definitely running beyond 2 years. So it is now become necessary for the government and extend it for a further period. So government thought these are, exemption which is granted a period beyond 2 or 3 years. So that is something which need not go through the rigors of government extending it. So there is an amendment which is carried out. So that is this amendment. I think this is something which could possibly reduce the work or the onus of going through this extension every time by the government. So this is only a facilitative change in my view. Tony, if you can take it to the next one. Now we come to settlement of cases. Now, this is something which is pretty interesting. In fact, of recent past, there is hardly any interest with respect to the settlement commission under the customs law, for various reasons, because there are applications which is still pending before various authorities. So now the government, in the guise of bringing in a timeline within which the settlement commission has to dispose of the application, 9 months is the time limit which is prescribed there, and there is there is an option which is available there for the authority to possibly extend it for another 3 months. So 1 year is the time limit within which the settlement commission has to dispose of the application. But the issue is this: if it is not disposed of within a period of 9 plus 3 months, then the particular application stands abated. In other words, it is as if that application has not been filed, and which makes the adjudicating authority to dispose of the case as per the provisions of the customs law. So this is something which is likely to anyway. I think there are not many takers for the settlement of cases under the customs law. I think this could possibly be the final nail in the settlement of cases under the customs law. There is another amendment with respect to the countervailing and anti-dumping provision. I think this is something which is being amended effective 1995, 1st January 1995. Now, there is a little bit of history behind this because, as you know, where domestic industry is representing before the Director General of Trade Remedies, where there is a dumping or there is a safeguard duty which needs to be, or countervailing duty needs to be imposed, they make a representation to the government. The government, then the DGTR, the Director General of Trade Remedies, will take up this proposal and he will invite details from the parties involved in the transaction, and then he will review that. Then finally, he will estimate what is the extent of duty that needs to be the additional anti-dumping duty or safeguard duty which needs to be levied, and the recommendation goes to the government, and the government eventually issues a notification. Now, in the recent past, there has been a number of review which is done by the DGTR, which is pending before the government, and the government has not initiated or issued a notification to levy duty on this, and all of them are lying there. Now, there was some rulings in the past which says that the government is eventually required to pass an order. So unfortunately, there is no order. Now the government wanted to make a retrospective amendment so that the appeal or only the review or the determination by the DGTR alone can be subjected to appeal or challenge, not the governmental action of not issuing a notification around this. So this is what the proposal is. Moving forward, now this is all about customs duty rate. I do not propose to touch upon the customs duty rate, but there is one amendment I think which might be of interest to many people, because the customs duty applicable in project import scheme, which is kept at a low 5%. Now this is something which people have been using when there is an expansion or setup of a new plant or substantial expansion of an existing unit. In all those cases, people used to approach and get this permission for a project import. Now the government wanted to keep solar power plants and solar power projects outside the scope of the project import scheme. So accordingly, an amendment has been carried out. Now, some of you might recall, there were some position which is being taken by various producers of solar power. They say that even though they may not be eligible, or if it is not coming under the project import scheme, they could instead of suffering a larger, higher custom duty rate, they could possibly try and set up a unit as a manufacturing and other operations warehouse. So that is something which is specifically being, or rather, notification, a circular has been issued by the government saying that that benefit is not available. So this particular import of solar power plant or solar power project may not be now available under the project import scheme also. So this is the next change with respect to the customs rates. So we will go to the central sales tax straight. Yeah. So there was a requirement for forming a appellate forum for central sales tax appeals against any order which is passed by the highest appellate forum in the respective states, and which was now is sought to be, or rather the proposal is to make CESTAT as the authority for settlement of all such cases where there is an interstate dispute with respect to the interstate sale of goods, which is the appropriate state. There could be, litigation surrounding that. Also, whether a particular exemption would be available provided you file a form F. So all such litigations now would lie before the CESTAT. So this is the next amendment. And any AAR, the AAR which is there in this central sales tax regime is being disbanded, and anything which is pending before the advanced ruling authority as it stands today, that will also be shifted to the CESTAT. So that is the only changes in CST. And lastly, we are coming to the central excise. Of course, as has been the case in the past, every year there is an increase in the rate in respect of cigarettes. So I think the range is about 15 to 16% is the rate of increase in the excise duty on cigarettes. And the other amendment, the last one, which I would like to touch upon, and this is about the excise duty on blended CNG, where you would be using GST paid biogas or compressed biogas. So those items, to that extent of the GST suffered on that, would be reduced. So that is the amendment which is coming in. So I think that's all the proposals from an IDT perspective. So back to Ronnie.
Yeah, I think thank you very much, Dinesh. Simachal, perhaps we can bring you in at this point of time, just to probably throw a few questions your way. So from an industry, maybe I can just start off with just asking Simachal, from your perspective as part of the tax, as tax head of an industry, especially one such as Dr. Reddy's, what is your take in terms of what the budget has accomplished. And I have a few questions in terms of some of the amendments, especially on the MSME sector bit, and also provisions relating to the assessments and litigation. So perhaps you can just start off with your viewpoints, and then we can go on to some of those questions.
Yeah, thanks, Ronnie, and good morning to everyone. So from my perspective, actually, when I went through the budget, I thought not many amendments are there, but as the day passed on, I could come across some of the amendments which are very relevant. And very honestly, this time I got queries more on the personal tax front rather than on the corporate tax front. Okay. Yeah. Okay. So one very good positive thing I noticed is there is no adverse impact. There is no retrospective amendment creating an adverse impact as far as the direct tax is concerned.
Yeah.
That is very welcome move, and it is very heartening to note that. The other thing also I could see the positive is the creation of another appellate forum, that Joint Commissioner Appeals. So that will definitely foster resolution of smaller appeals. In a year, typically we get one main appeal, that is against assessment order, and we come across various smaller appeals, as you told. So those things will be faster. I'm not talking about the outcome, but I'm saying the resolution part.
Yeah.
Okay. Yeah. The third thing is, of course, this innovation excellence center, what government spoke about, that is going to enhance the R&D activities by pharma companies. And MSME is a positive move. MSME will get the cash flow much earlier. What I noticed is kind of not so good is I saw one provision where the assessing officer can ask for an inventory valuation report from a company during assessment to be done by cost accountant. Very few provisions speak out cost accountant, but I was very happy to see this one of them, although I'm not a cost accountant. But the thing is that this is again a kind of a special audit kind of provision that has again crept into. And I hope this provision will not be used very often, considering the fact that the cost of this audit is going to be paid by government. Okay. Yeah. And the other thing I noticed that it should have been in place, but it didn't come. There is a reference to any Pillar 2 provisions, because Pillar 2 is a certainty now.
Yes.
I was expecting some kind of mention should have been there, as per the Pillar 2 is concerned, saying, guys, you get ready, it is coming after a year. So that kind of message should have come in the budget.
Yeah.
So this is my very brief take on the budget. I'm not getting into other aspects. So.
Sure. Maybe Simachal, we could possibly do one thing, and Dinesh, Simachal, perhaps we can just look at some of the questions that have been posted online. I have attempted to answer some of those questions while the presentation was going on, but Tanaya, how do you want to do it? Because I know we're almost at the end of 75th minute. We can for another 5 minutes possibly, if that's okay with you.
Sure. So we'll maybe take questions for 5 minutes.
Yeah. So there's a lot of questions on the, I think primarily on the personal tax bit.
Yes, a couple on indirect tax, but a lot on the direct tax bit.
Direct tax front, right?
Yeah.
So maybe shall I just pick up the questions and then probably address them? There is one question, and I'll go by, by sequential. One is by Akansha. Akansha, you make a very valid point in terms of, the idea of providing exemption was to promote social welfare. But it's also discouraging now individuals by taking away those exemptions, right? But I think, Akansha, the intent of the government has always been to deal with less number of deductions and exemptions to rationalize the enactment itself. So that's obviously, something that has been the intent of the government, and we will see that intent go forward. I think this government, when it set up, and I think this was right at the time of Mr. Jaitley, did announce that we want to do away with all these exemptions. We want to do away with this whole exemption culture. or deduction culture and try to bring a more rationalized tax system. So I think this is the intent of the government. But yes, your point is well made. But nevertheless, I think India is growing as an economy. So therefore, one does hope that at some point of time, a social structure centered around social security will come to play. There was one question on the personal tax bit on the threshold of 10 CR. Uh, uh, no, it is 10 CR in totality. So I think that's a question, that, yeah, was there the threshold of 10 CR under section 54 and 54F is in totality. Yeah, thanks. Um, um, uh, Kuldeep also had a question under amendment to section 48, interest on loan claimed. Kuldeep, I do not know. I'm just trying to read through the question. Can this be interpreted that interest on loan can be added to cost of acquisition if one is following the new tax regime, since under section 24 can't be claimed under the new tax regime? Any thoughts on this, Simachal, if you have any thoughts?
Yeah, so two things can happen. If you get into new tax regime, you don't have an option of claiming these under section 24. Definitely, you should go for the other route, that is adding to the cost of cost of acquisition under 48, right?
Yeah.
If you get into the old tax regime, or you rather continue the old tax regime, your choices are wide open. Okay, either you claim under 24, 2 lakhs, then balance you add to the cost of acquisition, or alternatively, you add to the cost of acquisition the entire leave. So that's my view.
Okay. I will deal with some questions on Dinesh, maybe I can get your question on one indirect tax question. In the case of Flamingo, court held sale from duty-free shops as export. Now credit is restricted bond to bond. Any views on it?
I think this is something which is fiercely litigated matter. I think this is something we have to get some conclusion on those litigation, because there are arguments on both sides. So as it stands now, it's not settled. So it is still on. That particular area of dispute is still being fought. So
yeah,
it will take time to get some settlement on this.
I am also dealing with some of these questions where the 54F discussion has been already dealt with. So the answer is that it is a 10 crore limit. I also see on the chat box one question from Mr. GP Ramchandran. The percentage of investment to GDP, which used to be around 39%, has come down to 32% presently. If the government's preference is the new regime, will it not further impact the ratio of investments? It's not personal investment critical for investment growth. Mr. Ramchandran, this is well appreciated. From a reference point, obviously, one does view that the Indian economy, which was the 10th largest in 2010, is now the 5th largest. But certainly, this does lower the kind of investments for especially personal investments, and this is social investments for individuals. So the ratio of investments has come down, which could obviously be impacting the growth, but certainly, one does view that the government will have a relook on it. The thought process around some of these changes has been to move away again from the whole culture of investment-based incentives for tax savings, and also to move a simplification or a rationalized structure. We can hope that it will bear fruit at some point of time. But I guess personal investments will still continue, because as Indians, we continue to be very focused on planning for the future. So hopefully that is there. I have a question from Bharati. Bharati, on charitable trust, there's been a whole host of amendments. Unfortunately, time will not permit us to take through, but I think suffice to say that the memorandum covers them quite exhaustively. So you may want to look at the the provisions and the explanatory notes in the memorandum. They're quite exhaustive insofar as the amendments to the charitable institutions are concerned. There was one question from Kishore. Can you highlight on Vivad Se Vishwas 2? Uh, uh, Dinesh, would you want to comment? Simachal, do you want to comment? Because I'm not saying anything in the current budget, but not sure if this is something to be answered here.
No, there is some proposal to come out. There is some proposal for amnesty under the GST law. That is, even customs law also there is some discussion.
Yeah.
So anyway, there is no discussion. There is no announcements here. I think we expect that something might come out because there is already discussion around the small infringements under the GST law.
Yeah.
Similarly, some of them under the customs law. There is a proposal or there is a discussion which is happening. We expected that this is something which is likely to be announced, but we are still positive about it.
Yeah. Okay.
So there are a couple of other questions also which came in there.
Sure.
I think Simachal, you have anything to add? Otherwise, maybe I will possibly try and touch upon those questions.
Sure. Sure.
Yeah. So one is, of course, there are a couple of questions why the GST tribunal has not been set up. There is an announcement about it. Yes, this is something which is being discussed, and in fact, recently the government has made a representation in the Supreme Court that we are in the process of setting it up. So there are some legal issues. That is something which is being sorted out. So in fact, everybody is expecting looking ahead with a fond hope that this will be set up very fast. The other question which came in is about reversal of ITC on high sea sales, because of course there is an amendment, but that amendment appears to be restricting to only warehouse sales, because the inbound sales only. So it doesn't appear to reach inbound sales, particularly when it comes to reversal of ITC, is the impression that we are getting as we look at the provisions. I think that's it. These are the questions.
Right. Tanaya, we are...
one more last.
Sure.
I think there is another one.
Yeah.
Which I think there's a question by Rajesh. He's asking GSTR 1 and GSTR 3B filed after 2 years. Then credit is allowed. Actually, the answer is no. There is a time limit which is specified there. I think 30th of November is the time within which you're going to take the credit. The extension from 2 to 3 years is for a different purpose. That is only for filing of return, not to take credit. So that is something which I just want to touch upon. I think that's it from my side.
Yeah. So, Ronnie, regarding this MSME, I just want to sensitize. Can I?
Yeah. Absolutely.
With regard to this MSME provisions, I think all the companies should go through the terms of agreement. If there is, first of all, whether there is an agreement at all. If there is an agreement, then the payable days credit terms is 45 days.
Correct.
If there is no agreement, then it goes back to 15 days only. So that is one of the very important point. We all have to see whether there is an agreement in place first of all. If not, we have to enter into the agreement very first. And second thing, of course, the payment has to be done in time. Otherwise, the interest get disallowed permanently. Of course, principal will get back when you pay it. And third thing, if at all we are running short of time, we all must ensure that at least the payment that is outstanding on 31st March, that should be paid. So that you avoid the disallowance. This is a short point I thought I was just...
Yeah, absolutely. Good point you made, Mr. Monty. If you see, there were some questions on the MSME sector. I think the primary takeaway, especially on that, is when dealing with the MSME sector, do have contracts in place. Secondly, I think you're right, because it's a 15-day credit period if there is no contract in place. And if there's a contract in place, the maximum, it talks about the maximum period. So again, the contractual cannot exceed 45 days. So therefore, these are three things that you need to be mindful of. And a good planning opportunity in terms of if there is due on 31st March, please pay it before 31st March to claim that expense. Else, it will only be allowed in the next year. So therefore, there will be a cash outflow which could impact your advance tax. Therefore, your interest consequences, etc. So the companies would need to significantly revamp at least their dealings insofar as MSMEs is concerned. I think this is one big takeaway, at least for the industry, at least for the manufacturing and supply chain industries where there are significant linkages.
Sure.
Yeah. Tanaya, we are, I don't know whether we're done, but I think we're close to 1.5 hours, well past our deadline. So any guidance in terms of, the next steps?
No, I think
So
sorry. Yes,
I have a small or just anxious to know from Simachal, was there an expectation around the special economic zone, or what is the response to that, or about some of those changes which needs to be effected by the Ministry of Commerce, whether it is foreign trade policy or SEZ? Do you think that this is something which is likely to happen in the coming? I know it's a guess only, but I'm just asking. What is your guess?
Dinesh, frankly, we are expecting the this bill to come up very fast. Okay, we're all waiting for the this bill, and I know this bill is entangled between the discussion between the revenue secretary, revenue department, and the commerce department, because there is asked that SEZ should get 15% tax rate. I think that's the point on which this is stuck. That's what I came to know. I'm not very sure of this. Once it comes, definitely I'll must say that there will be a upswing again in the SEZ activities.
All right. Thanks for that, Simachal.
Yeah, thank you.
Tanaya, over to you. I think the panelists are at the end of almost a 90-minute discussion.
Right. No, so I think it was a very riveting session rather, and I think it was clearly evidenced by the fact that we had around 450 participants logging in and sort of asking so many questions. I think we had more than 30 to 40 questions today. So great participation by the audience as well. So I think with this we would like to close the session for today. So I would formally like to thank, our BDO partners, Ronnie and Dinesh. Thank you so much to both of you for such a riveting presentation. And I think I'd like to offer a special thanks to Simachal for specially joining in and providing us with such an insightful industry perspective. So many thanks to all our three speakers, and thanks to our participants for a patient listening. I think overall it was a great session. So thank you so much to everyone.
And thank you all. Thank you all. Bye-bye.
Bye-bye.